Hello everyone, this is the Recce report on February 18th, 2023. I know I announced back in late December I was back on YouTube after a long hiatus. After the first of the year, I got sick. I had a really bad cold that felt almost like the flu. And it was not COVID. It was just a bad cold. I got over it after a week and a half, and then after that I was busy with various things going on in my life. In any case, in today's video, I'm going to introduce some basic concepts that I think you'll find interesting and useful in a practical way. So AI has been used for algorithmic trading in the stock market and for trading of various other financial securities, including cryptocurrency, in the currency market and the bond market. And high frequency trading using computers has been in use since the 90s. And in the last few decades, especially since high frequency trading rolled out, the share of finance as a percentage of the economy has increased drastically, and finance is now 20% of the economy. And this means that less physical products and more financial services are being produced. And this essentially means that the economy is being increasingly organized around the development and sale of financial services and less around manufacturing and designing products. And during the 2008 crisis, one of the things that contributed to the start of the 2008 financial crash was that we had the trading of derivatives among investment banks and hedge funds. And what derivatives are is that when banks sell mortgage bonds to investors, the profitability of the mortgage bonds depended on the ability of the banks to repay these bonds, which meant that there was a possibility of loss or risk that these investors were taking on by buying these mortgage bonds that were backed by a number of mortgage loans that were made in the housing market. And so what banks did to mitigate that risk was that they offered investment banks the opportunity to buy what became known as credit default swaps. And this essentially meant that if the bond that these investment banks were buying a swap for were to default, then the investment banks would make money. So in other words, if, for example, a bank were to sell a mortgage bond to investors and then have mortgages that were backed the bond lost money, and then the bank was unable to repay, and there was an investment bank that had bought a swap on that mortgage bond, then the investment bank would make money because they had purchased a swap on that bond. And so this creates the potential that as high-frequency trading becomes more sophisticated, as more advanced technology allows for it, that banks and financial firms will continue to innovate and come up with new ways to trade securities in ways that are potentially risky for the well-being of the economy and financial markets. And AI has become more advanced in recent years, especially within the last 5 years. We've seen a number of companies, including Google, coming out with new products that are related to AI. And AI has already been used to model data, and especially for predicting trends and mapping out potential scenarios. And this is especially useful when it comes to predicting trends and analyzing data in financial markets. And so this means that as AI becomes more advanced, the algorithmic trading used by financial institutions will become more sophisticated and potentially more accurate. So this essentially means that the economy will become more organized around finance as financial institutions become more profitable due to algorithmic trades being more effective as both AI and quantum computing emerge as being increasingly useful in a financial setting. And there are already central banks that are trying to create a digital currency. In fact, the Bank of England is already talking about creating a digital currency. I'm going to link an article about this story in the description for the video, because I think it's an important story that once you see how these central banks are trying to create their own digital currency, it actually calls into question whether or not digital currencies are actually an escape from the centralized control within a currency that is issued by a central bank. And there are a number of potential risks and problems with cryptocurrency, including that in order to mine digital currency, it actually requires a great deal of electricity. And I will cover this issue in a later video, but I think for now in this video I just wanted to briefly highlight some of the issues with the idea of financial capitalism rather than what I would call manufacturing capitalism, or basing the well-being of the economy on the creative productivity of the population, which I think the well-being of the economy would be a much broader definition than what I just stated. But when I'm in this case, I'm primarily referring to how you measure the productivity within the economy. So there's some institutions, and such as banks and financial institutions, that would envision focusing on financial capitalism and focusing on the growth of the financial service industry as a measure of well-being within the economy, whereas within a more productive and manufacturing mentality, you will find that there are industry leaders that would look more towards physical productivity and income as a measure of well-being within the economy. And that's because in an economy that depends primarily on manufacturing and agriculture, so you're going to find that those economies cannot sustain themselves without a strong consumer base and a strong middle class. Where areas in the economy that focuses on financial capitalism, it does not depend on the consumer or the income of the overall population, because the only thing that the success of the financial institutions creating financial services and engaging in the high-speed trading of financial securities for profit is their ability to engage in the financial markets in a manner that is profitable. And this is an issue that I think I'm going to make a part 2 video about. So I hope that you enjoyed this video, and I plan on making a video about twice a month, and maybe next time I'll make it a little bit longer, and I'll try to incorporate some more articles and maybe some more practical data to explain the points that I'm trying to make here. Goodbye, everyone, and God bless.